Welcome to Tesla Daily News Podcast. It's Thursday, January 8th, 2026. Today, we're breaking down what's moving Tesla right now, fresh pressure from Nvidia in Autonomy, Tesla's aggressive financing move in China, what the latest data says about demand in Europe, and a few headline risks investors should not ignore. Story 1. Nvidia just threw a very public punch at Tesla's autonomy narrative, and the market noticed. Here's the context. Tesla's valuation still carries a major autonomy premium. Anything that changes investor belief about Tesla's odds of winning robotaxis and high-margin software can move the stock fast. The details. At CES 2026, Nvidia unveiled an open, self-driving AI model family called Alpamayo, positioned as a platform to accelerate autonomous vehicle development. Multiple reports linked that announcement to Tesla shares dropping roughly 3 to 4% in a single session. Impact. Investors are weighing a world where autonomy becomes more platformized, meaning automakers and robotics players can adopt common building blocks instead of betting on a single closed stack. That doesn't mean Tesla loses its lead overnight, but it does raise the question, does Tesla keep its software advantage, or does competition compress the autonomy premium? Takeaway, watch how Tesla responds in two places. First, actual full self-driving performance and safety data, and second, commercialization. The market will care less about demos and more about paid, scalable services. Story 2. A rare, high-profile endorsement of Tesla's FSD from Nvidia's own CEO. Hook. Jensen Huang called Tesla FSD 100% state-of-the-art, which is not something you hear every day from a company that also sells autonomy tooling. Context. Tesla's FSD strategy relies on showing its approach is competitive, even as rivals use different sensor stacks and different compute philosophies. Details. In coverage circulating from CES and investor media, Huang praised Tesla's approach as hard to criticize, even while explaining how Nvidia's platform differs. Impact. In the short term, this can offset some of the negative read from Nvidia is competing with Tesla. It frames Nvidia as both an enabler and a competitor, selling picks and shovels to the whole industry while acknowledging Tesla's technical strength. Takeaway. For investors, this is a reminder that autonomy is becoming a larger ecosystem. Tesla can win even if Nvidia wins, unless the ecosystem shift reduces Tesla's ability to capture the majority of the profit pool. Story 3. Tesla China is leaning hard into demand stimulation with 5-year, zero-interest financing. Hook. Tesla is effectively using the balance sheet and financing partners to pull demand forward in the most competitive EV market on Earth. Context. China is where pricing pressure is most intense and where BYD and other local champions are strongest. Incentives and financing are now a primary battleground. Details. Reports say Tesla China rolled out a 5-year, zero-interest program covering Model 3, Model Y, and a 6-seat Model Y variant, plus a discount of about 8,000 yuan. Impact. Zero-interest offers can protect sticker price while lowering monthly payments, which can help sustain unit volume. The trade-off is margin pressure either through financing costs, incentives, or a mix of both. Takeaway. If you're watching Tesla as a stock, this is a classic volume versus margin signal. The key question for the next earnings cycle is whether Tesla can hold automotive gross margin X credits while keeping deliveries from slowing. Story 4. Europe demand signals remain mixed, with clear weakness in several markets, but strength in pockets like Norway. Hook. Tesla can be down in Europe overall and still post local wins that confuse the headlines. Context. Europe has become a tougher market, more competition, changing incentives, and consumers delaying purchases as prices and interest rates move. Details. Multiple European-focused reports highlight falling Tesla sales across key countries in 2025, while noting a record share outcome in Norway. Impact. Investors should treat Europe as a margin and mix story, not just a unit story. If Tesla defends share via price actions, it can protect the installed base and future software revenue, but it risks compressing near-term profitability. Takeaway. Watch not only registrations, but also pricing discipline. Tesla stock tends to trade on margin expectations when growth is uncertain. Story 5. BYD overtook Tesla in global electric vehicle volume, reinforcing the reality of a more competitive EV landscape. Hook. Tesla is no longer the default largest EV maker in every dataset, and that matters for sentiment. Context. Tesla's long-term bull case is not just about selling EVs. It's about scaling manufacturing efficiently and layering on software, energy, and autonomy economics. But unit leadership has been part of the narrative. Details. A German business report citing EV market analysis says around 1/4 of new cars sold globally in 2025 were electric, and that BYD sold more EVs than Tesla in that period. Impact. The market may increasingly compare Tesla to best-in-class manufacturers rather than treating it as the category by itself. That can tighten valuation multiples unless Tesla clearly monetizes software and services. Takeaway: Tesla doesn't have to win unit volume to win shareholder value, but it must show differentiation, cost per vehicle, margin resilience, and attach rates for software features. Story 6. Tesla's Cybercab naming and trademark issues add noise to the robotaxi story. Hook. Tesla appears to have hit trouble locking down the Cybercab name, and that's an avoidable distraction. Context. The robotaxi narrative is one of Tesla's biggest potential upside catalysts. Anything that suggests execution sloppiness, even branding, can feed investor skepticism. Details. Reports in European and Russian tech outlets say Tesla's attempt to register Cybercab faced a pause at the US Trademark Office, and that robotaxi is also not straightforward as an exclusive name. Impact. This is not a fundamentals driver like deliveries or margins, but it can contribute to a perception risk at a sensitive time, especially with autonomy competition in the headlines. Takeaway: investors should focus on substance, regulatory progress, safety performance, and real-world operational plans. But don't ignore how execution details influence market confidence. Story 7. A potential U.S. safety and regulation overhang, manual door handle legislation. Hook. Lawmakers are looking at requiring manual door releases in new vehicles, an issue tied closely to the kinds of powered handles Tesla helped popularize. Context: regulation can force redesigns, add cost, or create headline risk, particularly when it touches safety narratives. Details: Bloomberg coverage indicates a U.S. lawmaker is preparing a bill that would require new motor vehicles to include manual door releases, citing safety concerns with electrically powered door handles. Impact: near term, this is more risk headline than immediate financial impact. But if it advances, it could mean hardware changes across models, additional validation, and incremental cost. Takeaway: watch whether this becomes a serious regulatory process or stays at the proposal stage. For Tesla traders, these stories can create volatility even before anything is enacted. Quick close. Today's big themes are autonomy competition getting louder, demand support via financing in China, and mixed signals in Europe as the EV market matures and BYD's scale grows. Near term, that's a recipe for valuation debate. How much autonomy premium does Tesla deserve, and what happens to margins if incentives rise? For tomorrow, keep an eye on any follow-up from CES around autonomy platforms, plus additional regional delivery and registration data that can shift demand expectations. If you found this useful, subscribe to Tesla Daily News Podcast and follow us for your daily, investor-focused Tesla Roundup.